This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. I know that here on the show, we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. Hello, and welcome back to Bank Nerd Corner. We're like odd lots, but we're only obsessively focused on banking. My name is Alex Johnson, and I am joined, as always, by the banking and fintech editor at Bank Director, the wonderful Kiah Haslett. Kiah, how are you?
Good. How are you?
I am doing well, thank you. I am excited to see you in person soon. It's actually been a while since we've seen each other in person.
I think it's been 2 years.
I know. This is crazy. So I'm very excited to be at the same conference, Finovate Fall, at the same time.
Yep.
By the time folks listen to this, we will already have seen each other in person. We will have recorded a very spicy live Breaking Banks podcast episode on stage with our friends Jason and Jason,
The Jasons.
as well as some other wonderful guests. So I'm looking forward to that. And I'm looking forward to today's conversation. Kiah, before we get into the weeds, on a prior podcast that we participated in, we did come up with a new rule. One of the things I like to do every once in a while, just because I've apparently vested myself with this power, is I get to name rules that exist in banking and fintech. And we now have a Kiah Haslett rule that I would very much like for you to explain to the audience.
Yeah. So I have talked about what in banking is a type of account called a FBO account. And FBO accounts are old accounts that were set up because banks recognized that some professional service firms would sometimes hold money of customers of the professional service firm, but they would want to put it at a bank. And so the account would be open for the benefit of this end customer, not for the benefit of the professional service firm. One thing I think about is like in real estate, the escrow account. There's some legal accounts. You could do it for like a guardian if you had a minor guardian, and that that was a very specific type of account. Then for FBOs, I guess they might have gotten applied to deposit brokers, and there'd be some paperwork that a deposit broker would have to submit to both the bank and to the FDIC in the event of failures to ensure that the pass-through insurance worked and that the regulator and maybe the acquiring bank could know who this money belongs to when there's that handoff. And FBO accounts became the account structure du jour of banking as a service. And I understand some of the structure, why that structure would lend itself to fintech accounts, but I really think we need to kind of move away from FBO accounts and from the stated purpose of these accounts and maybe some default assumptions about some of the ledgering that would have to the bank, who should maintain the ledger of the FBO account and the paperwork. And I also think that we should just like update all our terms, right? We're talking about broker deposits, and it always gets brought up that broker deposits were this one thing in the 80s, and now they're this other thing today. And
but we're still talking broker.
We still call them brokered.
Yeah.
And then we get into semantics, and I think you've already lost the debate when you are talking about the words you're using.
I agree.
And so I think we should all make an effort. Maybe not the FDIC, that might be proposing a rule that relates to this, but all of us in the industry should try to change our language and use that to change our mindsets around this and really start calling them Fintech Custody Accounts. That if you're in banking as a service and you have a omnibus account for your fintech partner, one maybe should be, hopefully, operating and one should be custody. And then you would talk about your custody account and then say, well, whose money are we custodying? What is that customer's name? And really kind of talk about it in that way. And then, obviously when the FDIC asks you about your FBO accounts, you should respond you should include both your legacy FBO accounts that the professional service firm uses, and then the fintech custody accounts that you now have with your fintech partners.
So when a regulator comes to you as a BaaS bank and they say, tell us about the way you sort of structure and reconcile your FBO accounts for BaaS, you'd be like, we don't have any FBO accounts.
I don't know if that's exactly how.
FCAs. And Kiah Haslett said we're not allowed to call them FBOs anymore, so we're calling them FCAs.
I think you need to fill out the paperwork the way that the paperwork says. But I just think that one of the things that's really interesting as we think about fintech and what the stated goals of some fintech is, and if it's truly to be innovative and disruptive and to really push financial services into the future, I think you can just stop using the terminology from the 80s. One of the things that as a financial writer, I sometimes run up against is when I have to write about cybersecurity, I find the prefix cyber to be the clunkiest, jankiest prefix in the world. And it makes it when you affix the prefix cyber to anything, security, shopping, it just feels like the 80s, right? It feels bad. And I really need a different word for cyber. And unfortunately, and then all of the art with if you ever have they have to put images with my stories and stuff, right, and the stock images and stuff, and it's all ones and zeros. It's the Matrix, right? It's 1999 in my articles when I write about cybersecurity. So I just want us all to be using language that really reflects both our current operating environment and where we want to go into the future. And I think we need to start I think we should probably move away from the FBO, FCA account anyway. But if we are going to use FBOs to do BaaS, we should really approach them as custody accounts and think about them that way. Not as a big pot of money.
Fair. No, that's fair. All right. So you heard it here first. The Kiah Haslett rule is no more FBO if you're talking BaaS. Say FCA, and credit Kiah when you are having this conversation with your bank supervisors.
When I see it in a regulatory speech, I'll know. That's what I do. Is I look for things that I've talked about, or sometimes I've interviewed a regulator recently, and he said one of my tweets back at me, and I was like, in my head, I was like, do you have a burner account? How did you find this tweet? I know they're out there, but
I'm convinced that they all have burner accounts, which actually makes sense because there is some really good, smart bank policy type stuff that's talked about on Twitter. And so I would want to know what's going on. And obviously you can't do that under your own name. So
I block accounts that I think are bots. And so I hope that I didn't block this regulator's burner account.
Well, as long as they weren't snotty in any way, then I'm sure you didn't. I have no problem with anonymous accounts as long as they behave themselves. Kiah, let's get into the news. We actually are going to revisit this whole FBO account ledgering reconciliation question a bit later. But before we do that, I joked before that we're odd lots, but more focused on banking. But you're going to take us into sort of odd lots territory a bit with this first topic.
Odd lots comes from my turf. I don't go for their turf.
Fair. Okay.
Yeah. So when this podcast comes out, we will be about a week away from the Federal Open Markets Central Bank meeting in September, where everyone basically thinks that they're going to announce the first rate cut this will be the first rate cut since March 2020, right? We've just been zero to rising. And it, I haven't looked at the futures market because I hate the futures market, but I don't know if it's going to be a big cut. I remember the last time we were in a rising rate environment in 2018, they would be 25 basis point increases, and everyone would be the word hike. They would say they hiked interest rates by 25 basis points, and I would change the word hike. And so the question is, it might be
that's more hitched it up.
Slightly, they slightly increased, and so it's not. I don't know what the futures market is saying would be the first rate cut, the size of the first rate cut. It's likely, not, I don't know if they'd be 75 basis points the way we saw interest rates increase. But it is making a lot of people talk about the potential of a decreasing interest rate environment and the impact for banks. So I wanted us to talk about kind of some of the things we think might happen in a decreasing interest rate environment. And I want to say decreasing. So like I work at an Orange Theory, and sometimes like they'll like do an incline, and then at the top of the hill, they'll be like, okay, go from 15% to 12%, go from 12% to 10%. And then they'll say you're going downhill.
It's
and
like,
that's
wrong.
You're going up a less steep hill. So I will say that like these would be decreasing cuts, but I don't think we can really start talking about low rates until we get into kind of the 2% category.
Totally.
So
agree.
these are my little pet peeves about how we talk about rates.
It's all about language on today's Bank Nerd Corner. Yeah,
all about as we've already lost, but yes, we are talking about semantics.
Right. So. No, that's totally fair. Okay, so run me through some of the big things. I mean, you spend a lot of time listening to what bankers are saying and talking to bankers. Like, what's the general mood on? I mean, everyone obviously wants rate cuts, and this is not exclusive to bankers. Obviously, like anyone with a vested interest in the economy seems to sort of be anticipating rate cuts eagerly, to the point where I think Jerome Powell might just not do it just to spite us, but we'll see. But what's in a banking context specifically, what are the main thoughts?
Yeah, so I think one of the things we might see, and I don't know when we would see it, I don't certainly think we'll see it in September, but if interest rates are lower, the like mortgage rates might be lower. And so you might see more or pick up in home sale activity, which would be positive for banks if they can make marginally more mortgage loans at rates that are still pretty high. Again, these are still pretty high. And that would be a great long-term asset potentially, that you're getting a borrower that thinks they're getting a little bit better of a deal from a mortgage perspective, but can still afford the rate. The other thing too, from a credit quality perspective, is it may alleviate some pressure for some commercial real estate buyers that are able to refinance. Now, one of the things I think that's complicated about commercial real estate is there's a valuation problem, and then there's the amount of the refinance loan problem.
Right.
Those are two separate problems. I think a lower interest rate helps the latter of those two problems. It might make a refinance loan a little bit cheaper, but it doesn't change the problem.
But fundamentally, if you're kind of underwater on the value of the property that you bought, that doesn't really adjust that problem.
Right. And also the other thing too about commercial real estate is there's a maturities wall. And so the loans that are coming due in 24 and 25 were made about 5 years ago. And so interest rates, there's just no universe where the interest rate of 24 and 25 is going to be close to the interest rate that the loan from, 2019 or 2020 carries. And so, I think there might be something that marginally, maybe a bank is willing to kind of extend some of the terms of the credit or make some sort of adjustments and has a little bit more flexibility and ability to do that. But we still kind of have some like structural issues with commercial real estate that I don't think within 100 basis points we're really solving.
Right.
So that'll be interesting. And I think commercial real estate should I keep waiting for commercial real estate to crack a little bit more meaningfully so we can just kind of work through it. There's just something about like waiting for something bad to happen versus just the bad thing happening. And we can just move through it. Right. But we are kind of like in purgatory.
No. So. Yeah. Well, no, that's very true. I mean, there's a bunch of stuff like that. I feel like in the current economy where it's like, yeah, it's not great. Like I feel this way about auto lending too, where it's like,
I have no idea. Is auto loans? I didn't even think about auto loans, but those car prices are crazy. Like the interest rates on those,
insane. Yeah, and so it's like it kind of relates a little bit back to mortgage lending. I mean, mortgage lending is the big one that moves really quickly when you change rates, even a little bit. And I do think, to your point, like I live in Bozeman, Montana. I can just tell. I can just like taste on the air. There's like these buyers that are sitting there, and they're like, interest rates are too high. But as soon as it ticks down even like a teeny tiny bit, they're just going to jump off the sidelines, and it's going to be like a feeding frenzy. And buyers, or sellers, I should say, have been waiting and kind of keeping the prices of homes relatively steady. Like they haven't been cutting prices because they know what the home is worth. And so I think like real estate could overheat very quickly with a relatively small increase in interest rates, at least in specific markets. So
Yeah.
I think that one is really interesting. Auto lending and like broader consumer credit, I think, is fascinating. I mean, the cost of borrowing is high, so I do think in some ways it does discourage certain other
Mm.
forms of consumer lending. Like there probably are some folks who've slowed down on car buying a bit, just because, again, the prices of the vehicles aren't coming down and interest rates are kind of too high, and there's only so much kind of chicanery you can do, like extending the
Yeah.
term of the loan to adjust the payments and that kind of stuff. So that you might see a little bit of an uptick there. Credit card would seem unlikely to really change too much. I mean, I
I don't
think the
think it'll be
biggest thing,
meaningful.
yeah, the only thing would be like maybe it kind of softens delinquencies or defaults a little bit, just with the interest rates, if you were to decrease those a bit, putting a little less pressure on consumers. So there could be some small stuff, but
Hmm.
functionally, I feel like a lot of that stuff won't change. Let me ask you kind of a more I don't know, philosophical question in a way. Since we've been in this rising rate environment, we've seen sort of the dynamics there. If rates were to tick down a little bit, how do you think banks would reprice both on the asset and the liability side?
Yeah, that's, I think, going to be really interesting is how interest rates, the decrease plays into NIM,
Yeah.
and specifically cost of funds. I will
Yeah.
say that, from market-based funding, probably cheaper.
Yeah, sure.
So you could
That's nice.
kind of prepay some of your market-based funding and replace it
Mhm.
with cheaper funding,
Mhm.
potentially.
Yep.
And then I have been wondering about like the direction of cost of funds and the rate of change, right? So
Yeah.
cost of funds they really took off, I think, the second half of last year, and then this year
Yeah.
and when I say like they took off, I mean the slope of the increase was high. Banks had been able to successfully not pass along interest rate increases to their customers at
They
the
were
first
keeping
half of the rate.
betas really
Yeah,
low, right, for the
but
first half of last year.
but SVB really unlocked that door. November 2022, SVB, everyone kind of got smart and started looking at interest rates. And so banks have really been fighting to keep cost of funds low, but also retain customer deposits. And also because when the customer's deposits leave, you might need to use market-based funding. And now you've just
Mhm.
taken you have the full cost of it's like the full beta, basically. And
Right.
so my question is, I think one of the easiest things is like maybe like CD pricing is going to come down. So if
Mhm.
you're using brokered CDs, if you're using listing service, and if you're raising CDs yourself, you will have some more pricing power on the CDs.
Yeah.
I don't know if you will be able to successfully lower the interest rate that you are paying some of the large accounts that have negotiated. I don't know, what went into the negotiations, if you asked for more of the deposits, if you asked for more of the business, treasury management, things like that. And then I also don't know contractually what you included for lowering the interest rate. So I
Right.
use a high yield savings account. I've already seen my high yield savings account start to lower my rate. And I
Right.
don't know, I don't know how like widespread that is.
It's like in
But
anticipation of the rates going down. Like they
yeah,
haven't even
I
gone
mean, I think
down yet, and you're
it's like
like, "Ah,
forward curve stuff. I don't know.
they were trying
I
to
really hate
price
the
it
forward
in."
curve. Yeah,
Well, no,
they're
it
definitely pricing
is
it in.
it is strange though. It is odd from like a customer perspective to like I mean, I'll just speak personally for myself, having navigated this with high yield savings and a couple other things. It has been very strange as a consumer to be on the one hand like on the trailing edge of them
Yeah,
trying to keep deposit betas low and like, hey man, can I get like a higher rate? What's going on here? Like, are you really going to make me like shop around and go get
yeah,
something better? Like, what's happening here? And then for banks to kind of reluctantly go, okay, all right, like, and it like feels like I've
yeah,
dragged them to a point where
right.
I'm getting pretty good rates. And now even prior to rates going down, they're like, hey, just so you know, like,
Yeah.
I just want to prepare you, like,
Just manage your
rates are going to go down,
expectations.
manage your
Right.
expectations. And it's like, really? Like, I
Yeah.
do wonder both, especially for commercial accounts where this is more of a negotiation, and then more on the consumer side, how much leeway banks think they have and how much they have
Oh,
contractually
yeah.
to like really be able to push customers on this
Yeah.
versus like, hey, you spent so long holding betas down,
Yeah.
we're going to be kind of pissed at you if you don't keep them relatively competitive, at least for a while, especially if the rate decrease is
Yeah.
relatively small.
Well, and the other thing too is I think that the conversation a customer has with a bank when rates are high and rising about, hey, can you pay me more for my deposits, is going to be different than when rates are decreasing and the bank's like, hey, we're going to lower your deposits. And the customer's like, I will shop this around. Like, thank you so much for letting me know that, this is how you value my business. It's not clear if everyone's going to move in lockstep too, right? This is kind of a prisoner's dilemma for all the banks. Like, you can lower your customers' rate if all the banks lower their customers'
cooperate.
rate.
Everyone cooperate.
Right. And then the other thing too is, again, I think that there are moments where customer money wakes up, and maybe this is and I don't know if it's going to be this rate decrease, but we might be at another inflection point again where the money moves, and maybe it won't be as much money, but it might be some money. And I think it'll be interesting for banks to do liquidity sensitivity, maybe some liquidity, flow analysis, but also to think about, actually how much pricing power do we have? I will say that I just read a South State correspondent banking article from Chris Nichols, who looked at an FDIC paper and the relationship between bank NIMs and short-term interest rates. They looked at all the rate cycles since 1984, and the change in the median bank NIM during rising and falling cycles. And they found that, like, in general, during decreasing rate cycles, NIM will contract faster than it expands in rising rate cycles. During decreasing rate cycles, the industry's NIM compresses. So whether or not an individual bank's NIM has compressed in these rising falling cycles since 1984, overall, we can expect NIM to decrease. And also NIM's been decreasing since 1984 anyway.
Right.
And then
other factors,
community banks experienced a NIM decline in four of the last 5 decreasing cycles. So in general, like, I know that, and I think it's something interesting is, like, banks, the history and the data show that historically, like, decreasing rate cycles are bad for banks, or they're just not really able to manage them in a way that doesn't decrease the NIM.
Right.
And that banks feel like they are under so much pressure today because I think of the rapidity of the rate increasing that they don't think it's good that rates are high, and they want rates to be lower. But historically, decreasing rate cycles are bad for banks. And the question is whether or not banks understand the dynamics that would make a decreasing cycle bad for them versus the rapidity of the high rate cycle. So it'll be interesting.
Can we talk that out for just 1 second?
Yeah.
Because I am curious about that. So I guess the theory would be that, we're talking functionally loans and deposits in a rising rate environment.
In a slowly rising rate environment.
In a slowly rising rate environment.
You get to gradually make loans at higher prices.
Right. While deposits can sort of stay, you can compress that, you can keep that down. You can restrain deposit increases. But I guess the reverse dynamic applies in decreasing rate environments from a NIM perspective, where it kind of, I guess, relates to, like, the price sensitivity of different bank products in a way, right? Where it's like loans are just really price sensitive, right? Like, people shop. Yeah,
people will refinance a loan, right?
Right. Well, and loans don't have the same, like, utility to customers, I don't think, right? Like, a loan is just a thing to get a thing that I want. I really don't give a shit about where I get the loan from. Like, loans are not sticky from, like, a loyalty brand perspective. There's no real advantage to me as a customer. And you can argue that a little bit, but, like, functionally, I'm getting a loan to do some other thing. Deposit accounts, and we've had other conversations about the changing nature of deposits, but deposit accounts in general are more of, like, a utility product where it's like, I might value this for other things. And so while rate is a component to deposits, it's not the only thing I weigh. And so I guess the idea is I am going to be, like, less price sensitive on the deposit side than I'm on the lending side, which means that the ride up for banks when rates are increasing might be a little bit better from a NIM perspective. On the ride down, it's a little bit worse. Does that general theory or thinking make sense to you?
I think so. It's
obviously more complicated than that, but just in theory.
But also, like, when we talk about the things I know about banking, I kind of have this historical knowledge that begins in the year 2011. And so I've been through, like, 2 rate increases and I've been through 2 rate decreases.
Yeah.
And so in my head, I understand that like zero, like when rates were zero for like 7 years, that was bad for banks, but they kind of made it work. And they made it work because like you can kind of build from zero.
Yeah.
And then rates rose really, really slowly. Right. And in fact, apparently they only like, it was like 3% when they went to zero in March 2020.
I was looking at that because like prior to 2020, they were like rates are going up, and I was like, oh, were they? And then I looked, and I'm like, that's not rates going up, right?
Yeah, you forgot that rates actually went up from 2018 to 2020 because it was so slow.
Totally.
And it was so staggered, and so when rates go up really slowly, you can kind of mess with loans a little bit, and then I don't think beta has like moved very much, especially relative to today.
Well, because there is no like alarm bell going off in customers' heads going, man, rates have gone up a ton. I must be getting screwed.
I remember like talking about high yield savings in like 2018 and I was just a sweet summer child. But then to today, like, so rates were at zero in March 2020. And actually like, it's funny because again, banks have this like, banks know what to do kind of when rates are at zero for years. But the other thing we didn't anticipate was a lot of stimulus money that was missing in the post-financial crisis slow recovery. And so we all kind of had to build it up.
We dumped a bunch of deposits into the system.
And then banks like, I think what's, when rates are at zero, a lot of things are going to happen. You're going to get a lot of refi activity. You're going to make a lot of loans, right? You're going to make a lot of long-term assets. And then because it's so hard to get yield, you're going to buy a bunch of bonds, I guess, with all the deposits that you like kind of have to do something with.
You have to take,
yeah, or you have to pay out, right? You're just gonna you're not going to make any money on them, and then so it'll just be again. So there, I do think it'll be interesting to see because what happens in this declining rate environment. Because I do think one, we still have some excess deposits, and two, like we just haven't had technology factor in as much. And so, but I also think that like banks are kind of like overweighting the short-term pain that they're in that came from not necessarily rates being at 5%, but from rates increasing at the speed that they did. And we're still kind of processing all of that. Yeah. And if the pace of the decline is slower than the pace of the increase, that might, you might not get the benefits, right? You might right? You might like, we're still kind of processing through a lot of these things. So I don't know. I think banks are, it would be interesting if banks had to stay at 5%, that was our operating environment. What would you do differently today? You'd hopefully make some loans at 5% or at 9%, right? A 5% loan, you can have 9%.
Yeah.
And I don't know how fast that'll be competed away once rates start falling and customers maybe are a little bit more savvy and will negotiate or shop a little bit more readily in this environment.
Right. No, I think that's a really good point. And I do also think that, as we've talked about before, like technology changes how customers behave in a lot of ways, right?
Yeah.
And so, the historical comparisons are useful, but also not, in the sense that like the mechanisms I have as a customer to shop around change thanks to technology. And so I think every cycle is a little different from that perspective as well.
Yeah.
So it will be really interesting to see. I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com. Yeah, Kiah, can I move us to our next story?
Yeah.
So We're going to talk about this on Bank Nerd Corner because I didn't want you to experience me saving this for Mikula on
Oh my
Fintech
God,
Recap.
the other bank reporter you have on your show on a regular basis.
So take this, Mikula. We're talking about it now. This is actually kind of breaking news because it was reported this week that the FDIC is contemplating a new rule that would essentially require banks to maintain ledgers for, and I'm reading from the news report, Kiah, so don't get mad at me when I use the wrong terminology, for benefit of accounts opened by third-party fintechs so that banks can identify how much end-user money they're holding. So obviously, this is a pretty direct response to Synapse. The details are a bit scarce, but from what's been reported in Bloomberg Law, what it appears to require is either the bank to maintain the ledger that the fintech company or partners are using. So the bank is the one that controls the ledger, or if not, that they are getting a daily reconciliation of the ledger that the fintech company is using that they can then use to reconcile to whatever ledger they have to manage their fintech programs, which they can then reconcile to their general ledger. So the idea is to have a much better sort of reconciliation so that we can track which customers have which deposits, and we can avoid a situation that we've just seen sort of the worst case version of, where there's disagreement on that question and customers' funds end up getting stuck while we try to work through it. There are a couple interesting things to me about this proposal that I wanted to just bounce off you real quick. The first one is, obviously, it just bears repeating, this is something all banks that do banking as a service should be doing anyway. So it's just to say it out loud, it's crazy that there were any banks that weren't doing this. It is crazy, I believe, to really allow fintech companies to control the ledger that you use to manage these programs. I think if I was a bank getting into banking as a service, particularly now that I have all the leverage and like fintech companies have none because there's very few banks that are able to take on new fintech programs right now, I would insist you are using my ledger. Now, I'm not going to necessarily say you have to use my general ledger and integrate with one of the core systems that's not really built to facilitate this, but I'm going to pick out my own sort of side core or other ledger that I'm going to use. You're going to use it, but I maintain it. I have contractual control over it. Any disagreements that arise contractually, we're going to agree that my ledger is the correct one, and I'm just going to force fintech companies to do this. So it is crazy that banks aren't already doing this en masse. A lot of ones are, but for ones that aren't, like, this is a best practice. But I think the other thing I'm curious about, Kiah, is the FDIC is the one driving this. Their interest in this is really interesting to me because I think on the one hand, they've definitely taken some flack from the public, from the media, from Congress on like, why aren't you helping solve this problem? So I think part of it is just like, hey, we're listening, we're trying to solve this problem. It's not directly in some ways in their wheelhouse because I think, we'll see what comes out of the Synapse situation, but I don't know that we have incontrovertible evidence that the money wasn't being accurately reconciled at sort of an FBO level. Now, again, like there are disagreements about that. There could be a pot of money missing. We don't know. But, in general, I don't know that you can say like the Evolve Synapse mess was a huge safety and soundness issue, at least in sort of a traditional sense. And so, and the FDIC in some of their initial reactions to it kind of hinted at that, like, hey, the bank didn't fail. Like, this isn't really our thing. And then the third piece to it is more from an insurance fund perspective. And you talked about this before when you were pitching a new term for FBO accounts. A lot of the original sort of interest in this account structure from an FDIC perspective comes from deposit brokers where there is a need to apply what's called pass-through insurance, which depends on, among other things, accurate record keeping for these accounts so that we know in the event of a bank failing, if pass-through FDIC insurance up to the $250,000 limit will apply to the sub-accounts within this omnibus account. So I mean, in general, I'd love to know kind of what your take was on this news. And then specifically, if you kind of put on your FDIC hat, like why they're doing this and what they're thinking about.
Yeah, I share that I was low-key stunned that this wasn't a rule. And I like to think about, the things that you have to do and the things that you should do. And again, the role that a bank examiner or regulators more broadly can play in how a bank should operate.
Yeah.
And so I think this is one of the things, again, the FBO account is a legacy of product. This is a number of banks have failed that have FBO accounts. And there's actually a system that deposit brokers can use to submit their paperwork to the FDIC to say, these are our customers, and the reciprocal networks also have this exact same problem as well.
Sure.
So this is not a new process or system. It is not a new practice. And I think deposit brokers realized it was in their interest to make sure that they had dotted all of their I's and crossed all their T's with the FDIC, not just with the bank, right? They were not relying on the bank to maintain this paperwork. They were being able to submit documentation to the FDIC for the legal coverage of the insurance. So I think this is great that it's a rule. It's crazy that it wasn't a rule. I don't know how much this should change anything about any intermediary middleware. I hope that it changes none of their processes. And they were like, it's crazy is we've been doing this all along.
I'm sure they will all say that.
Company that wasn't doing it.
I don't know that will actually be true, but I'm sure they will all say, "Oh yeah, we've been doing this for a very long time." And
I find it unbelievable. Like my like cynicism says that it's not only the banks that are involved in the Synapse partner banks that will have a big that like weren't doing this, that weren't doing daily reconciliation.
Yeah.
And so, like, I also will say that this is probably a lot of work, right? It is a lot of work. If you are a bank that is currently in a BaaS partnership and doesn't do daily reconciliation, it is probably a major undertaking similar to this bankruptcy proceeding to figure out the documentation. It is probably not just looking at 2 Excel tables and comparing the amounts, right?
Right.
And
no, it's tough.
It's going to be a big undertaking for the banks that currently have these partnerships. I hope that this would actually make everyone feel a little bit better about this partnership, about BaaS. And it hopefully will make the direct, indirect conversation, like it'll flatten it. It'll flatten the differences between direct and indirect.
Because like regardless of who I'm dealing with, the bank needs to know what's in these accounts. Yeah.
Bringing up safety. So safety and soundness, I think, is interesting. I think, there's a concern that some of the shortfall is not going to be able to be found. Let me just euphemistically say it that way.
Yeah.
That would be a really big problem for a bank.
For sure.
There is a bank that failed in Puerto Rico because they thought they were going to get a tax return from the government. It went to court. The court said, no, you're not going to get this tax return. The amount of the tax rebate was so big that the bank became insolvent.
Oh, wow.
And regulators had to close it. Yeah. Missing a lot of money in a bank is really bad. If you think money should be there and it's not there. So there actually is a safety and soundness component to making sure that the ledgers match and that the bank knows how much money should be in the bank. And there's not any question about where are funds. And so...
Well, and the more complex these relationships become, the easier it is for a large amount of money to go missing or to be in dispute, right? I think that's the other thing that's changed is like in the old deposit broker world, it was fairly straightforward. And even when you were talking the deposit brokers would maintain very kind of clear records that they could submit to the FDIC. But the thinking there was it's much more likely for the bank to fail than it is for a deposit broker. That like a deposit broker is not going to go bankrupt or disappear. Something weird's going to happen.
We have in the insurance oh my God, great financial crisis. A lot of brokers did fail, but they were acquired, right?
They were acquired.
How did we get Bank of America, Merrill Lynch, right?
Right. So it is kind of, I don't know, it's more complex now. And so to your point, if you try to untangle the web of Synapse and their own brokerage and their ability to have multiple bank partners that they were doing. Like there was a lot of complex reconciliation that needed to happen that I think increases the odds of there being a safety and soundness issue, to your point.
And I also think, I agree that this might be the backdoor way that everyone figures out passer insurance if you do bank with a fintech that you just know that you have.
It'd be nice to
insurance.
know in advance.
Yeah,
like that would be, as a customer, I'd like to know that.
Yeah, I actually had someone text me and ask like, "Hey, how do I know if my money is insured?" And she was just like, and she doesn't bank at one of these fintechs. She just has like a lot of money, I guess. And so, and she was asking about her and her husband's accounts. And so I sent her the FDIC's page about how do I know if my deposits are insured. And she's like, I tried this and it like didn't actually fully work for me. It like didn't really answer my question.
Yeah.
And I was like, well, I guess the other thing too is you could very painfully go to a bank and ask someone how like your bank structured yours and your husband's accounts to make sure that you have money. And then I said like, and I'm sure the FDIC hates that I said this, but I said, there are banks that offer extended deposit insurance.
Right.
And the question is whether your bank is one of them and what product you need to get into. And, or I could just Google like X bank plus, extended FDIC insurance and then send that to you.
Right.
They offer products specifically designed for if you don't want to answer this question because the FDIC won't tell you how much your money is insured based on how your bank filed some paperwork, right?
It is a very non-transparent thing, right? And I think that, we talked before about like the FDIC is a victim of its own success from a resolution perspective and the like ability to, they always tie a neat bow on it. And so everything's wrapped up by Monday morning, we're good to go. And so like there is, I think, this feeling on the part of customers that like, as long as what I'm doing is vaguely associated with the FDIC, I'm good.
Yeah.
And I think as a result of that, the FDIC has not spent as much time working on mechanisms to provide a more granular way to reassure customers about the status of their deposits and if they actually are insured. But like, just from a first principles perspective, I think it's totally reasonable for me as a consumer to be able to say, so here's all my money. Can you please tell me in which pots my money sits and the sort of safety of those various pots? Like that's not an unreasonable question to want to be able to get a simple answer to. And because you mentioned the sort of extended FDIC insurance, I have to say, I find it very strange how difficult and sort of opaque banks make it that offer extended FDIC insurance to get that product. And if it's purely a concern about the extra fees you have to pay to participate in those deposit networks, like get over it and just like make that a core feature of those products. That would be my take on that. But yeah, it is weird how consumers are kind of slowly, and businesses certainly since SVB, are waking up to this idea that like being associated with an FDIC insured bank in some fashion might not be the level of due diligence I should be doing on this, particularly if I do have complex finances in some fashion.
The other thing too is one, so we know that the FDIC has actually gone after deposit disclosures between fintechs and banks. And so this feels like actually a proposal with teeth rather than like, what they were doing is like being more concerned about misleading. They're like, hey, if you actually have this partnership and if you are advertising FDIC insurance, here's how you're going to make sure you do it. And it's going to be a lot of work, but if you want this product and you want to advertise this product, this insurance product, this is actually how you would do it correctly.
Yeah.
And do it truthfully. And then the second thing is this is like, it's so funny that one of the biggest stories in fintech has been like reconciliation and ledgering. Which is like the least sexy, innovative topic. But I've been thinking a lot about the role that internal and external audit and accounting can play in BaaS, and the role that like when an examiner goes into a bank, they'll like check the loan files, right? They'll like I don't know, and they'll like sometimes like I think they like look at the wires, they'll like add up the wires and stuff. Is my sense. Sorry, I don't know if that's true, but it's not clear for BaaS, like if they looked at an FBO account or an FCA account and then we were like, hey, can I see what the ledger says for your partner? Like, and it's not clear who would do that. It's not clear if like, I'm sure like the daily reconciliation manager will now be doing this, but who checks that guy's work?
Right.
And is external audit, there should be like fintech, like banking as a service, external audit that doesn't just check like paperwork and policies or whatever, but like kind of checks the math and could identify, some of these discrepancies before they become really, really big problems, before there's a lot of money that goes missing. And I feel like I haven't heard enough about the checks on these types of systems. The other thing too, and this is like kind of goofy, I had a friend who like didn't connect her Venmo account to her bank account. And she asked me about Venmo being FDIC insured. And so I was
it's complicated.
So what I said was, no, but yes, your money's not insured.
Right.
Because it's not in a bank. But what I can tell you is Venmo puts your money, Katie, puts Katie's money, and also it was $300. My friend opened her Venmo. She had $300 and hadn't connected it. So this is all like money she gathered and it's how she like paid people back in Venmo.
Sure.
So she needed a lot of money in Venmo because she wasn't going to connect her bank. And so I was like trying to explain to her that like Venmo likely has a big bank account somewhere. And $300 has Katie's name on it. But if Venmo fails, she might lose that money because it's not clear if Venmo, like what account structure Venmo uses at this bank. Are they, does this fintech custody account is it in a reciprocal network, right? Because I imagine maybe Venmo has a lot of money,
one would think,
right?
Yes.
A lot of these balances. So I had to tell her that like her money wasn't quote unquote in a bank, but it kind of quote unquote was in a bank, but that it's not clear if the bank knows it has her money. So if Venmo fails, she might not get her money because they just don't know it's hers. Or it might be like, there might be so many claims ahead of hers. And so now I'm thinking about this rule. And I'm thinking about whatever bank holds the Venmo balances that aren't in the Venmo bank accounts, right?
Yeah.
And like the work, if that FBO, if that FCA does not have a ledger with my friend Katie's name and the balance of her account in it, like that's crazy. That's going to be so much work for that bank on this one fintech's account, right? On this one custody account, right? Like that's crazy. But now Katie will get that pass-through insurance, and she didn't need to connect her bank to Venmo, right?
It is a really good example. I am imagining that Katie ran away from you screaming when you got done explaining this.
She asked me how Plaid works, and I was like, I can't eat. Like that's where the conversation went. And I was like, Katie, just connect your account. Why are we talking about this?
Like, what are we doing? You gotta get your money out of there. No,
but now she doesn't have to, right? Because it'll be documented.
And like it is interesting because a lot of it, and we'll move off this topic, I swear. But like the last thing I want to say about it is, I do find it really strange how a lot of this comes down at the moment, and this rule should help, which is great. I think you and I are both in favor of this being a formal rule. But it is strange how in the absence of this type of rule, a lot of this gets down to like you as a customer sort of underwriting the risk of the provider, right? Yeah. So like, how likely is it that Venmo picked a bank that would fuck this up?
Right.
How likely is it that Venmo, or I guess PayPal, would go out of business and wouldn't be able to like do the reconciliation themselves? How likely is it that, like, another example I've been talking to people in my life about is like, is Chime safe to bank with? And I'm like, yes, in the sense that I think they're a very mature fintech company with lots of processes and procedures, and they have people who are thinking about this stuff and caring about this stuff, and the banks they work with are generally banks that have been in the space for a long time and know what they're doing. So like, my guess would be yes, if I'm just underwriting the risk of the responsibility of the companies involved. But I don't know,
and there's actually no way for you to check either.
There is no way for me to check.
There's no way for any Chime consumer to meaningfully, like, because Chime's not public, there's just not a lot of disclosures that you can get on Chime that would make you feel more confident in Chime. So we're all just kind of gesturing. And I think a lot about, like, if you ask if your money's safe, it's already like game over, right? Like you don't want anyone to ever ask. That is the
question that the FDIC wants no one to ever ask, which again goes back to like their astonishing success rate at resolving failed institutions and stuff. It all has to do with, we don't want you to think about this.
Yeah. So if you're thinking about it, we've already kind of lost. You've already lost a little bit of trust in the financial system.
And so maybe that's the answer, right, to this whole question of like, why is the FDIC doing this? Is when they look at the Synapse-Evolve thing, what they see broadly is people asking these kind of questions that they've never asked before. And this is the FDIC going beyond, hey, don't use our logo in that way on your website, and doing something more concrete to say this needs to be happening if it wasn't before, because we don't want people asking these questions in the future.
It's also, and we can stop talking about this, but it's also flattening BaaS. There's just not two ways to do this thing anymore.
No,
you can do it directly. You can do it directly. You can do it not directly. I don't want to say indirectly, but you don't have an option anymore. There is, and I just think that, I think it's actually I think it's kind of good that there's just an agreed upon way. We are done debating the different ways to do this business.
Right.
There are two ways to do it. You do it directly, or you do it with this like intermediary ledger that might have a sidecar core that you were trying to avoid anyway, and you just have to do it. And so that I would like
regardless, you're going to reconcile or you're going to control the core.
Right.
That makes sense.
And and hopefully like everyone can kind of stop talking about, like, it should make the unit economics on this, like, or the work on the bank side, like a little bit clearer.
Right. Maybe more expensive, but clearer.
It'll be more expensive, but you won't hopefully get in trouble. And it'll allow you to figure out how much manpower and what kind of technology you'll use. And then that's just a cost. Those are just embedded costs now.
Right. And now you can just decide, do you want to be in this business or not? Okay. Kiah, that was great. Again, in your face, Mikula. All right. So now we are going to end with, let's do one of our questions. And I'm going to be selfish, and I'm going to pick the one that I want to talk to you about, which is sort of a wait, but why question.
Okay.
Wait, why is the OCC talking so much about financial health, Kiah Haslett?
Okay, so I think you know a little bit more about this than me, so we should have rearranged this, but...
No, you're the expert, go.
I had the pleasure of interviewing acting comptroller Sue in February, and we, one thing I ended up talking to him about, and I'm looking at the article now, so we talked a little bit about liquidity, and FedNow. And then I asked him, like, what is your longer term focus when it comes to like customer data in open banking? Because, that's very topical. And he said an answer that kind of surprised me. And I don't know if it surprises you, Alex, but he's really focused on financial health, which is not banking safety and soundness. And it is not bank profitability, but is in fact about, the people who use banks and how they feel about their finances. It's obvious that like money's a big stressor, and that, I think banks can do some stuff, but they can't fix a lot of like, wage issues or financial, external financial issues. But he is curious that banks have a lot of data about their customers through transactions and balances and stuff, accounts. Why, and he told me, why aren't we doing this on an individualized basis? The analogy I give is vital signs. When you go to the doctor, they collect a lot of information about you, and you can track that information over time. The data doesn't need to be perfectly granular. It can just give you a sense of, are you spending, saving, and planning? We should be able to do this. And he's like, I'm passionate about this because I find myself in a lot of conversations where I'm like, someone will say, are you for or against buy now, pay later? Are you for or against overdrafts? Are you for or against earned wage access? And he says the answer is nuanced. For some people, these are lifelines. For some people, they're abused. But they kind of speak to an issue, which is the financial health of people. Sometimes these are good products that are better than alternatives. Sometimes but there could be other products or other approaches that would be good fits. And it's so interesting because, like, in general, bank reporting indicates like regulators think overdrafts are bad and banks think overdrafts are good. And now we're having a conversation about who's right, rather than like, why do people overdraft? And what are some non-fee products that would address that? And how can we help people use overdrafts better? And I did bring up, like, why does the OCC care about this? And isn't like the CFPB the person that should be like caring about consumers' financial health because they've got consumer in their name? And he's like, well, I just think everything's kind of overlapping, and I just don't want to keep arguing thumbs up, thumbs down on products. And he said, like, if you take the thumbs up, thumbs down on product conversation to its logical conclusion, the best way to protect consumers is maybe not to just have any products. And that's not a world that makes a lot of sense. And so can we have more nuanced, better informed discussions around consumer financial health and then talk about the products that they should be available to them? So that is what I know about the acting comptroller's interest in financial health and this like health vital signs.
Okay, that is great. So first of all, I figured you'd have the answer, and you did. You interviewed him on the record, and you asked him this question, so you had the answer.
I don't know as much as I don't. You are so much more in this headspace than I am, though. I had to literally be like, "I'm sorry, why are we talking about this?"
Well, it is a little different, right? I mean, that's the kind of point, is that it is a little more, I think, in my world, because it isn't as directly related to safety and soundness or to the profitability of banks. But I do think he does make a really interesting observation about the thumbs up, thumbs down approach. There is this element, and I see this actually at the CFPB, right? Again, speaking of the agency that has consumer in their names, one of the challenges I have with the CFPB on some of this stuff is they do tend to often adopt the viewpoint of consumer advocates who are very fiercely protective of consumers and sort of tend to assume that all products are predatory unless proven otherwise. And so there is, I think, this mentality from a true consumer protection standpoint, which is, let's just assume if this product is used by some consumers in a way that's non-optimal, that it is entirely a black and white issue and this is a bad product that needs to go away. And that's why the CFPB tends to take a pretty hard line on BNPL, on earned wage access, on overdraft. Like the CFPB, at least under Director Chopra, has not been super interested in like the nuances of how people use these products. It's certainly in like the rulemaking that they've done recently. So I do think it's cool that there is a regulator who is taking a more sort of, well, it's interesting because it's balanced between, obviously, we want banking to work well for consumers, and we do care about these products being good for consumers. We care about consumers' financial health. But I think the OCC does have a little bit more of a lens on, banks need to make money too, right? Like banks need to be able to offer products that they make money on. And if the balance is this is good for consumers overall, and banks can also make money and be profitable, then that's a win-win, and that's good for the system. That's good for everybody. But I think, again, I one of the things I like about acting comptroller Sue is he does approach a lot of these topics with a lot of nuance and trying to sort of understand it from a data and a first principles perspective. I think the question he's digging at, that's a really good question, is why do banks exhibit almost no interest in understanding the financial health and trajectories of their customers? And Kiah, I want to bounce this back to you because I want to put it in like a bank analyst perspective, right? If you're a bank analyst and you are trying to evaluate the health and sort of future performance prospects of different banks, because you might invest in them, you are going to be very rigorous about looking at data. You are going to be evaluating the performance of the bank relative to its price. And I would imagine, just as all investors do, you're going to be looking for a deal, right? So you are going to be looking to buy low and sell high. You're going to be looking for a bank that is maybe undervalued, but when you look at the sort of core components of their performance, and particularly like what you think their potential is, and maybe how they can, with certain good management, sort of nurture that potential and improve over time. You're trying to buy low on those types of banks and understand which ones you want to invest in. And then by contrast, you also want to have a really good pulse on what factors might lead to a bank suffering bad performance or, in the worst case scenario, failing. So it's strange to me, I guess, that we do this when we evaluate banks, but banks don't do this when they evaluate their customers. What are your thoughts on that?
Yeah, it's really interesting. One thing that's really fun about banks relative to other industries is the amount of data that's available via the call report, or that is reported because they are public companies and have public company disclosures. And banks have like a lot of very unique indicators. We call them non-GAAP, non-generally accepted accounting principles, but net interest margin, they all report that. It is a number they all calculate, and they report every quarter, so you can model over time. We also have mandated disclosures around credit performance, right? So loans that are 30, 60, and 90 days past due, non-performing assets, non-performing loans. When something goes into other real, they call it OREO. So, real estate that the bank has foreclosed on and is trying to process. We report on the fair value of assets. We report on the unrealized losses in bonds and the gains. And banks do that because the regulator makes them do that. They don't do it because they want us to know all their business.
They would prefer not, probably, I would imagine. Yeah.
But then you can make, and then again, this is kind of separate and apart from like, it's bank health, but like we do all this work and we have deposit insurance, right? Maybe we do all this work because we have deposit insurance, right? Like which banks should be paying more into the deposit insurance fund because they're looking a little risky. Right. And then we, the side benefit for the public and for people like me is you can use the data to model and to understand banks and to understand bank performance. And then you can delineate between really great performers and really bad performers. And you might have, a bank that puts up a lot of profits and takes a lot of risks. And maybe that shows up in their credit and maybe it doesn't. The other thing too is when a bank is public, you can look at the share price and you can calculate how much a bank is worth in a sale, the tangible book value, right? The sum of all of these assets if you had to sell them. And then you can look at the TBV of the share price and you can figure out the banks that are like less, undervalued or overvalued. And you can kind of make judgments from there. And I do the other thing too. And, it comes up like what banks like might fail, like during credit cycles, what banks might fail. And in, during the savings and loan crisis or the Texas oil crisis, a lot of Texas banks were failing. And an analyst called Gerard Cassidy actually created like a predictive ratio for bank failures. And it's called the Texas ratio. And it's NPAs divided by the allowance plus capital as a ratio. And if the ratio is over 100%, so if non-performing assets make up more than 100% of allowance and capital, that bank's under a lot of financial stress and might be close to failure. It is interesting that we have created
being
this
able to predict that. Yeah.
And we have mandated disclosures that banks collect and then publish for their regulators. And it has allowed us to really create like this whole ecosystem around banks. And it created like SNL Financial, which is where I got my start. And yet we don't have, it's not clear that there's any systematized way that banks collect this data on their customers and then create some sort of analysis out of it, right? The value isn't like maybe the number. It's not the balance of the account. It might be cash flow. It might be like debt to income. It might be, like in YNAB, you need a budget. They have this like really kind of terrible metric called the age of money, but it's basically like, how old is a dollar that you spent today? Like when did that dollar get deposited into your account? And it's like spending activity divided by like the total balance. But it's like a number, and that number is a day. And they tell you that 30 days means that you are 2 paychecks, like you are spending money that was deposited 2 paychecks away, which means that you kind of actually can start maybe saving because you are spending really, really old money. But if you like go on a vacation that you've been saving up for months and you use all that money, then your age of money drops. And it like my bank doesn't tell me how old the money that I spend today is. And also my bank doesn't want me to grow that number. And so I do think you have a lot of people that are like, I feel stressed about my money because I feel like I'm going to run out of money because they don't have, and maybe because they do, maybe their age of money is under 15 days, right? Which means that that is a paycheck to paycheck existence, right? But like banks don't have, like, we just don't have that number. We don't have your failure number. We don't have your insolvency number, right? We don't have your capital number. We don't have a capital level for each customer, right?
Yeah. No, it's crazy. I mean, I totally agree with this. It's interesting because the one area where you do see this in banking is wealth advising, right? They have numbers, right? Like in wealth, they do, right?
I'm not a wealth management customer, so you can tell that I have no idea what you're talking about.
Well, I'm not going to say that I'm sitting on a massive pile of assets or anything, but I did have a conversation with a wealth advisor just briefly, and it was interesting because they have numbers, right? And they talk about like what's your target age of retirement. They can graph out like, here's your trajectory. They talk a lot about what your expenses need to be for retirement. So we have some of this modeled out for parts of people's financial lives, for certain segments of customers. But the thing I kind of come back to in that model is, and it touches on something you said before about it's not in the bank's interest. A lot of this relates to like incentive alignment too, I think, right? Because, if you go to a doctor, the incentive for the doctor is to make sure you're healthy and to make, like, they don't profit off of you being unhealthy. They profit off of like fixing your problem. And again, depending on who you go to, the incentives might get a little jumbled, but in general, like within healthcare, the incentives are pretty aligned. And in fact, we require doctors to take an oath that they will keep those incentives in alignment. And we hope that that kind of happens. In financial services, if you're a fiduciary, you have sort of the financial services equivalent to that Hippocratic oath. But outside of that wealth management fiduciary role, it starts to get a lot murkier because, to your point, if I'm like, I'll just pick on my bank that I use. I have a credit card with them, and I have a savings account with them. And it's ironic because the credit card is all about rewards. It's all about spending. This particular issuer makes a lot of money on revolvers. I don't revolve, but like they don't exactly go out of their way to disincentivize revolving balances. And then by the same token, the savings account is kind of off on its own little island. They did not, you'll be surprised to hear, notify me when I was not getting the best possible interest rate that I could be getting. And they were trying to keep deposit betas low, even though I am a very profitable credit card customer for them. And so I do think this idea that in banking, speaking of incentives, I think the incentive is to go out and try to acquire customers that already have a lot of wealth. And, that was SVB's model on the commercial side. On the consumer side, you see this with a lot of banks. Like Fifth Third, I think, was one that I saw recently that was really ramping up their like private wealth management business. Like the game in banking is, provide a sort of service or this sort of fiduciary like responsibility to customers that have already acquired a lot of wealth. And then for every other set of customers, let's build a bunch of individual products that have a very complicated way of stacking together so that we can make money, but we don't necessarily have an incentive to care about the financial health or trajectory of those individual customers. So it's almost like the bottom of the base is all of these individual Legos that we've stacked up. We don't really care about that. And then the top layer is where all the people who already have money get to play and get to have nice sort of qualitative conversations about their financial goals. And so when I think about, acting comptroller Sue asking for financial health vital signs, one of the things I come back to is the structure of banks' business models and the way that banks make money does not really incentivize them to care about calculating some of those numbers that you were talking about for non-wealth management customers.
Yeah. The other thing too, or like, it is interesting that like the explicit purpose of wealth management is to make the person wealthier, but often you start with someone who has wealth and you can leverage that, right? You have the capital that can be leveraged.
It's better. The easiest way to make money is to already have money. Right.
On the consumer banking side, banks do offer products that help build customer wealth, the main one being a mortgage, right?
Yeah, sure.
That does not seem to be a product that fits within the a philosophy that a bank gives a customer, which is that we will help you build your wealth over time meaningfully by helping you take steps to accumulate capital and leverage capital.
Yeah.
And also, right, like having given you this product, having given you a car loan that helps you get to work, right? We won't help you understand and think about your financial picture. We'll just give you the car and then take the car payments, and then you have a deposit account that will get your paycheck in. And we're not really going to help you connect the two and help build your understanding. And let us know if you ever want to buy a house. Like, we'll be here if we can help
just
you
come
with
knock
that,
on our door.
Just,
no.
But it's different because I don't know if it feels now we're kind of getting into financial education, which I hate.
No. I mean, I
Like,
think it's product design though, to your point,
yeah,
right?
yeah, yeah,
Because like
yeah.
the thing I come back, like the auto loan is a great example where it's like, hey, you want a car? Cool. We can give you a loan for a car because we love giving out loans to buy cars. But like the question they don't ask that would be helpful, I would think, would be, so why are you buying a car?
Yeah.
Oh, it's because you want to you need a truck to go to work because you're an electrician and you need a
Yeah, you're
truck
electric.
to
Oh,
do
do you
your
want to
job.
form a business? Like,
Right,
do you
right.
need a
Well, and
business
not
account?
only like they'll push it in certain ways, but they won't ask questions like, okay, so have you thought about what truck you're going to buy? And
Yeah.
if this truck is for like work, you probably want to optimize for the longevity of the vehicle relative to the payments you're going to make, because the last thing you
Mm,
want to do is have to spend money to repair a vehicle that you need in order to make money, right? And so like
yeah.
there's a whole larger financial health conversation that connects to the job you have, the purpose of the vehicle, all of those things.
Yeah.
And like banks don't care about any of that. They literally are just like auto loan good.
Yeah.
And in fact, when they work with auto loan dealers, they want to make a loan at the biggest amount possible. And
Yeah.
so they are incentivized to help the, dealer sell you the biggest and most expensive truck, not necessarily the truck that would be good for your financial health. So there is this like missing piece where we're not optimizing against what's best for the customer's financial health. We're
Hmm.
optimizing against the P&L
Yeah.
of the individual product line and staying within whatever the bounds are for compliance, so we're not being like unfair or deceptive.
Well, and the other thing too is like I use YNAB. I use YNAB.
You're a
I use
fanatic about YNAB.
I YNAB made me an open banking convert because it helped connect for me that the data I have that is dispersed among now 13 credit cards and 2 deposit accounts and a couple of loans,
Yeah.
that I needed to put all that data together in a framework that helped me understand my cash flow. And it made sense. Like, no bank could provide me with this interface, and no bank could provide me. And also because I have like arguably 20 products,
Yeah.
that is a lot of work to kind of create a cohesive view of my finances. And I
Yes.
understand that, like, I'm like, banks right now, like, it's so weird to me that banks are like, hey, I have I have an online bank
Yeah.
account, and they're like, hey, why don't you just add your other account so you get a full picture of your finances? And I'm like, what are you going to do with that? Like, what are you going to do if you
Right.
if my one online bank account can see my one like brick and mortar account? What do you plan to do with that?
What
To
value are you
me,
going to give
I
back to
can
me?
look at 2 different
Yeah.
websites. I can open 2 different bank apps. I don't need to, but that's like, so now I'm kind of, I wonder like if 1033 makes this more accessible. But again, which like maybe it does. Maybe all the banks can connect to all the other banks, and then you can get a full customer picture.
Mm-hmm.
Then what? Right? Like,
It's a great question.
what are you going to do to make me wealthier? Right?
Well,
What are
and
you going to tell me?
1033,
Yeah.
I mean, one of the problems is like 1033 codifies infrastructure that already exists. So if banks
Sure.
wanted to do this,
They
they
could do
could
it.
do it now. They
Yeah.
don't need 1033. I mean, it's going to make things a little better in certain ways, but they could have been doing this for a long time. But to your point, no bank built YNAB. And I
Yeah.
think again, like the thing I keep coming back to is they just don't have an incentive to care about this. Now, I think if you paint a vision of the future, and this is like kind of the Matt Harris at Bain view of like how technology will change how financial services works, but like I do wonder in the future if there is sort of 2 different models almost for engaging with your finances. And one is like put it on autopilot. And autopilot is I have no loyalty to anything. This autonomous agent is just going to optimize my finances across a whole bunch of different elements. And, it's not going to be super personalized to me. It's not really going to make me feel like I'm in a ton of control. I'm in a Waymo and it's just driving without me touching the steering wheel at all. But I have a reasonable level of trust that's going to act in my best interest in a way that banks don't today.
Mm-hmm.
That's option A. Or option B is a bank goes out of its way to assemble a product that actually does help me feel in control of my finances. And they build a version of YNAB, or they build a
Yeah.
version of, whatever. People have talked about a lot of different ideas for what that could look like. But I think, and this goes back to acting comptroller Sue, I think the complexity is the thing that gets people hung up a lot on this stuff,
Yeah.
right? Because, and I'll pick on you just for a second. you are not normal in a lot of ways as it relates to your finances. I hate to tell you this, but
I had no idea.
I've talked
So
about this
offended.
in my in the articles I've written about PFM. This is the 15% problem, right? Which is there's about 15% of the population that wants to exert a great deal of control and is willing to put in a lot of work and time to understand their finances. And really what they want is a framework that makes sense to them that they can do that. And that can be YNAB or any number of other systems that are out there to do that. Works really well for the 15%. The problem is the other 85% that don't have the time or interest or cognitive bandwidth to be able to do it. And I think when Acting Comptroller Sue emphasizes vital signs, what he's talking about is, like in a healthcare context, yes, there's going to be people like Brian Johnson who are like spending an insane amount of time and money trying to live forever and trying to extend the human lifespan and have the money and bandwidth to be able to do that. Most people, though, just want to be able to pop into CVS, put their arm in the blood pressure cuff, have the blood pressure thing taken, and be able to look at a range and say, yeah, your blood pressure is okay.
Yeah.
Or no, it's not okay. You might want to go see a doctor about that. And again, I'm not sure what catalyzes the creation of that more simple framework, but I think the Acting Comptroller is wise to anchor on that because that's the 85%, not the 15%.
Yeah. The other thing too is like, I don't want PFM to be the answer. I don't think it is the answer. The thing that he asked me what number I could come, like what ratio. And I was like, I use YNAB and it tells me my age of money. And that gives me a sense of like my financial precarity or my spending rate or whatever. And I think that it's going to require, like, I don't know the thought that went into the call, making the call report and saying, actually, you know what, we can do non-performing assets, but you know what's actually really useful is 30, 60, 90 days. Then the non-performing assets, right? Or, you know what's useful is not just your total cost of funds period that you paid this quarter, it's the breakout, the line items that allow us to kind of see. And I think that you're going to need a lot of data so you can figure out really like what data can be combined to be predictive, to be useful, and then to tell a consumer, actually, like, hey, at your rate of spending, you're going to run out of money in like 4 days, or like you're going to overdraft in 4 days based on everything we know, or actually, if you set aside. It's like one of those, like that Acorn account that like is like, actually you could probably set aside $100 extra a month. Do you want to do that?
I love Digit.
Yeah.
It was
like,
awesome. No, it's great. Well, and that kind of stuff on a
small
level is doable. No,
but they don't.
The thing is, it is doable though, to your point. And I think that's the thing that's worth continuing to hammer on is there are simple little things you can automate and make easier to help with that stuff. And actually, speaking of your overdraft example, banks have introduced some of that capability right now. And so now that like some of the new stuff banks are doing with overdraft is...
But it's like a rewind, a 24-hour rewind, right?
Well, it's like a rewind. Well, some of them are rewinds, but some of them are like, link this account to another account and we will predictively move money over to cover when we think you're going to overdraft within certain limits. And so like, it's not from an engineering or a sort of optimization perspective, it's not impossible to figure out. Like it's a hard problem. It's not an impossible problem.
Yeah.
But again, and I guess this is why the Acting Comptroller is continuing to emphasize it and push on it and use sort of, I guess you'd call it soft power to sort of encourage the industry in this direction, is without the motivation to do it. You see it in fintech show up in little kind of flashes. You have YNAB, you have Digit, you see it in other places, but you don't see it as a industry-led effort and you don't see it typically from incumbents like banks. So I think that's a really good place to leave that. Kiah, before we wrap up, we've been going for a while, but I as always, want to leave you an opportunity to rant and to get something off your chest. So Kiah Haslett, go off.
Okay. Starbucks is not a bank.
Yes.
Starbucks is not a bank. Starbucks is a coffee shop. It's a chain. And Starbucks uses a stored value card to increase customer loyalty. Because if you put money in your Starbucks stored value card, which, like, again, that's fine. It's a gift card. You've seen them before. You don't get them from your bank. You tend not to get your gift cards at your bank, but I guess you could for Visa.
Yeah.
And then what that does to your behavior is it makes you pick Starbucks to go buy coffee And when you go to Starbucks, what you say is, hello, I have a gift card that is digital and on it is $20. I'm going to use that money and I'm going to release $20. Like, also, you're not giving Starbucks the money because you actually already gave Starbucks the money, but you're going to cash in $20 or whatever. Yep. You're going to redeem, and then you're going to get coffee back. And I just want, at no point did what I describe look like a bank. And I think sometimes like fintech people say stuff and I'm like, do you know how banks work? And this is one of those times. The thing that makes banks, and we've talked about this before. I've talked about this, is a big theme of my reporting. Banks do 3 things, very special. And that's why there's a lot of fintechs that kind of look like banks, but they're not. So banks issue transactions accounts, which means that they take customer deposits, and then customers can go back to that bank and say, can I have my deposits back? And the bank's like, yes. And you get your deposits up to the amount in the ledger, right? And you can do it at any time for any reason. You could put it in Monday, take it out Tuesday. Then they serve as backup sources of liquidity. They transmission monetary policy. They make loans. They have access to the payment window. They charge market rates. Okay, Starbucks doesn't do any of that. Like, Starbucks,
they're not a bank.
When you give money to Starbucks, you cannot get money back from Starbucks. That means that your gift card is not a deposit account. And I see this all the time because people are surprised. So many people have given Starbucks money without getting coffee from Starbucks. That is what that $10 billion number is. They have not made a loan to Starbucks. They have prepaid their coffee. And so that is the difference between Starbucks and banks, is like, that's not a loan. Starbucks, like, you gave the money, you'll never get that money back. You will only get coffee back. Starbucks is, and then people talk about like the float. That's wrong. That's just operating money. That's an operating expense that Starbucks immediately can deploy for whatever it wants to, because they're not engaged in monetary or like maturity transformation. And so I actually really need you to understand that if you say Starbucks is a bank, for any reason, you're making any kind of analogy, you're wrong and stupid. Starbucks is not a bank. Starbucks runs a really successful, popular gift card business. And if you think gift cards are banks, make something a bank, you don't understand banking. You don't understand gift cards. And it just immediately disqualifies you for anything else that comes out of your mouth is wrong and stupid, because at your core, you think Starbucks is a bank, and you say it publicly. And I just need people to stop doing it. You can make other points, which is the success, the customer loyalty, whatever, the payments. You can even make a weird payments thing, but it's not even really payments because the money really only goes one way. And that just doesn't feel like a payment, right? That's just, we can't get too excited about money going one way and then getting stuck there. And then you getting like a nice app that allows you to order coffee that you prepaid, right? So
it is a great point. It is a great point. I will say 2 things really quickly in response. One is, I did post a Twitter thread about Starbucks being bank-like. Now,
oh my God,
I will say,
I'm going to find it, and I'm going to make so much fun of you.
I will say this just off the top. This was done purely to game the Twitter algorithm to drive up the number of followers.
I'm so disappointed in you.
I know, I'm not proud of it. I will say, just to maintain some shred of credibility, that I knew it was wrong when we posted it. And I understand exactly the point you're making. I think to put a finer point on it, banks would tell you that their business would be 100 million times easier if they didn't have to give the deposits back to customers.
Yeah,
like their life would
who
be.
Among Us does not want to. But then you're not a bank,
right? Everything that's hard about banking comes from the fact that the demand deposit account, that they can demand their deposits back.
Maturity transformation is not for everyone, folks.
It's hard. It's really hard. Like the amount that I've learned from you in particular over about how banking works is really all comes back to like maturity transformation is really freaking hard.
Yeah,
and
Todd
it's
Phillips,
what makes banks special. It's what makes banks need to be highly regulated. It's why we care so much about monitoring their performance. Like, it's a hard thing to do. If you are not doing that thing, you are not a bank. And Kiah, I think you posted about this on Twitter and got some smart ass responses about, runs on.
Okay, there were some really funny. Okay, I will say, it is, if Starbucks failed, you don't get your money back, right? Because there's not insurance, because it's not a bank. What would happen is, so if there was like concern about Starbucks solvency, what would happen is everyone would go to Starbucks and cash in their value. So there's some.
I'd get a bunch of those like mugs that they have, like the city mugs from different places. Like I try to cash out that way. I mean, I think there is a conversation to be had, and we'll have it on a future podcast about the weirdness of stored balance accounts being more prevalent and more digitized in the future. Because like, I do think, kind of going back to our conversation about personal finance, I do think it'll be weird in the future when I have 14 different stored balance accounts that I'm incentivized to keep money in by merchants that I shop with, but not all the time. And then YNAB or whatever budgeting system I'm using is going like, yeah, you would have a lot of money, but you decided to commit $800 to this stored thing account that you can never get stuff out of except when you buy coffee or buy tennis shoes or whatever. So I do think it intersects with banking and financial services in interesting ways, but to be 100% clear, Starbucks is not a bank.
Not a bank.
I apologize for contributing in my small way to this problem. And Kiah, I hope that you will come back and do Bank Nerd Corner with me
I'll think about it. I'll decide next month if the harm that you have caused, the discourse, is what more or less than what I can do to correct the record.
Well, I appreciate that. I would only say that if you walk away from the podcast, you won't have the opportunity to correct me and to shape my understanding of banking moving forward. So think of it as your moral responsibility to come back next month and continue to nerd out
fact checking services I provide in the background to make sure you and Makila don't embarrass yourselves.
That's right. That's right. I mean, I think we both constantly think about like, is Kiah going to find something wrong in this?
I'm gonna make a lot of.
Better do one more pass and make sure. All right. Kiah, this was fun as always. Thank you for your time, and I will see you in New York. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.